welcome to the Global View on this Wednesday. Well, US consumer prices rose unexpectedly in November. The consumer price index was up 0.1%, while in the 12 months through to November, prices increased 3.1%, with food prices slightly higher while energy prices fell. Excluding the volatile food and energy components, core CPI increased 0.3% in November to be 4% higher on an annual basis, with rents keeping underlying inflation elevated. Well, Federal Reserve policymakers have begun their two-day meeting and are expected to leave interest rates unchanged tomorrow, although markets have pushed back expectations of when the central bank will begin cutting rates. US Treasury yields dropped steeply immediately after the release of that inflation data, with the 10-year down to 4.15% following the report, but then recovered to 4.21%. And the US dollar paired losses against most major currencies after the CPI report was released. The Aussie currently trading at 65.6 US cents. All right, well, to get across what we're seeing at a macro level in the States and how that is likely to influence investment strategies, I caught up with Kenny Polcari from SlateStone.
The core number went up by 0.1%. They expected it to be flat, so it came in at plus 0.1%. Now, the other numbers, the month-over-month numbers, ex food and energy, and the core numbers year-over-year and ex food and energy year-over-year came in right where they expected it to. So there was a little bit of a surprise just in that one number. I don't think it's enough to really start. Certainly, I don't think it's going to change the view of the Fed, because I don't think the Fed's going to do anything. I think they're going to stay on pause. If it does only one thing, it might just cause Jay Powell to reiterate his, slightly to the right, more hawkish stance, and as he tries to temper this idea that, there are March rate cuts priced in, that's it, they're coming, no questions asked. I think he's trying to get away from that narrative. And if today's number did anything, it might give him just enough room to say, look, we hear you. We're going to hold rates steady, but we're not committing to any rate cuts at the moment. In fact, I think he's going to leave the door open to once again suggest that rates could still go higher before they go lower. And I think that's kind of what today's report would do. But if you look at the way the market responded, the market, for the most part was up, other than the small caps, which were off just a tiny bit today. But look, the small caps were up 16% in 6 weeks. So the fact today that they sold off a couple of points is not anything in my mind to be nervous about. The rest of the market, the S&P, the Dow, the NASDAQ, trends, all traded broadly higher.
Yeah, you get the sense, don't you, Kenny, that the market's just that money is at the gate, ready to move once they get that signal from the Fed that cuts are on.
Right. Well, so I think a couple of things have happened. I think that there has certainly been money that's been being put to work. People feeling like when October came that, maybe when it started to bounce and find a support there, a lot of people that had bailed, they got nervous. They wanted to jump right back in because, there's fear of missing out. And oh my God, what did I do? You certainly had some of that. But now even up here, because I, for one, have thought we were a little bit overbought, right? Overextended. I did not expect us to keep rallying ahead the way we are. I expected some pullback, and maybe we'll get that tomorrow. Maybe when the Fed comes out, and I think if he does what I think he's going to do and be more hawkish, maybe we will get a little bit of that pullback tomorrow. But to your point, I think there's plenty of money on the sidelines. I think there's plenty of people that are just waiting to bounce, to pounce, to get into the market. And they've just been a little bit anxious, and they want more clarity from the Fed. I think the funny part about it is those are exactly the people that kind of miss the trade, right? Because they miss all this opportunity when they could have been in. And then typically what will happen is that they'll say, okay, now's the time to go in, and stocks are overbought. You'll see the market come in, and then they'll get all crazy. Go, see, there it is. It's a fixed market. No, it's not. It's about being in the market, not trying to time the market as a long-term investor.
Kenny, what sectors are you liking at the moment? Obviously, we've seen that growth, led by the mega cap, the Magnificent Seven this year. Just recently, those chip makers making a bit of a move. Are you seeing perhaps encouraged by a broader rally here?
I'm absolutely more encouraged by the broader rally, right? I think the fact that yesterday we saw the Magnificent Seven kind of come under pressure, I think what that tells you is, look, those stocks have performed magnificently all year, thus the name Magnificent Seven, right? I get it. But as we come into the year end and people are sensing that maybe we are going to come in for a softer landing, not this hard landing, maybe they do think that the Fed has been able to negotiate this Goldilocks economy, that they are starting to look at now at a lot of other sectors that have been underperforming, whether it's individual name or sectors. And look, I've already said it when we opened this up. The small caps, which had gotten absolutely clobbered, and by October, they were down nearly 20%, almost in bear market territory, have now taken that all back and then some, right? You've seen that in other names that have, as the other sectors, as the market is broadening out, consumer staples. You've seen healthcare start to regroup, right, and find a base and offer opportunity, because I think people now are looking for a reason, right? They're itching for a reason to kind of look for opportunities in other sectors than just the Magnificent Seven. Doesn't mean that they're out of the Magnificent Seven. It just means that they're looking for diversity away from it. So they're trying to put new money to work in these other sectors. So for me, I continue to like financials. I continue to like energy's down, oil's down 22% in the last month. I think this story about, the slowing global economy and oh my God, it's going to be that. I think that's overdone. And yes, while I do think that maybe the non-OPEC members are pumping oil at a faster clip than the Saudis and OPEC recognize, I do think that there's plenty of demand, right? I don't think the world is going to stop demanding oil at all. I just don't. So, on a sector that's pulled back, I find opportunity in energy as well.
Kenny, as we look forward to 2024, what worries you next year? Look, it is clearly an election year. What's the political risk, do you think?
Well, that is the first thing that kind of is on the top of my mind is the political risk. But remember what we talked about. The political risk creates short-term chaos. It doesn't really price stocks in the long term. So as a savvy investor, while it may cause some anxiety for the markets, what a savvy investor will do is understand when it's just causing anxiety and chaos versus really changing the fundamental story. So I think that's going to be both a risk and an opportunity, right? I think the other thing that kind of has me a little bit concerned is that the market currently is priced to perfection, right? The way the market is trading, you'd think that we're absolutely going to have this soft landing, that there's going to be no recession, that interest rates are going to go back down by 100 basis points, that the S&P earnings are going to grow double digit over 2024, and that the S&P next year is going to be at 5,500 by the end of the year. I think, listen, I would love to see all of that happen. But I think there's some risk in that, right? I think the S&P, double-digit earnings for the S&P might be a little aggressive, especially if, on the one hand, they're talking about earnings growing at double digits, but on the other hand, they're telling you we're having this global slowdown and that the U.S. economy is going to come into it's going to come into some difficult times. Well, then those two arguments are illogical. You can't have double-digit S&P growth if you're saying at the same time the U.S. economy is going to go and experience a difficult time. And so that's kind of illogical to me. So I think that there's some risk in certainly the economic data. I think there's also some risk in unemployment. I think you're going to start to see, while unemployment did tick down on Friday when we get the NFP report, all these economists say in order for the Fed to really get to their target of 2%, they have to see unemployment rise. It's a matter of, can the Fed get the unemployment to rise just enough that they get the inflation to come down without really causing unemployment to create, to spin out of control and, go 5% or 5.5%. That, I think, is going to be one of the concerns as well, that I think people just should have on the back of their mind for 2024. But again, as a long-term, as a trader, that's that daily noise that you have to listen to in order to be able to trade. But as a long-term investor, you kind of want to eliminate the daily noise and focus on the larger picture. That's what I think is super important here.
Okay, so consideration perhaps of a hard landing, that risk, maybe even geopolitical risk, see how that plays out next year. What are you making of those safe haven plays, such as the US dollar and gold?
So listen, I like gold. I think that if in fact they hold rates steady here, and if they start to get, we're going to get the dot plot tomorrow with the FOMC. That's where you get the anonymous members of the Fed to take a little pencil and put a dot on a piece of paper to tell you where they think rates are going to be. It's going to be interesting to see what that dot plot looks like. Is it going to now favor Is it going to be more dovish than it was in September, right? Because that's going to give you a clue into what the inside members of the Fed are thinking. And if you start to see a majority of them pointing towards lower rates, then yes, I think the idea of lower rates will happen in 2024. It's just a matter of when. And if that happens, you're going to see the dollar decline a little bit because, the dollar will decline as rates come in, the dollar will decline. It's just the way it works, right? Gold then should find some stability. I like gold. I like the fact that we had this huge rally in it. Now it's pulled back once again, providing what I think is an opportunity. Gold should find some stability right in here around the 1975, 2000 level is where it should find some stability. So I like gold. I do think the dollar will weaken if rates come down. Now, if the dot plot shows they're staying a little bit more hawkish and Powell remains a little bit more hawkish, then I think you're going to see the dollar rally because that would suggest that he's still leaning towards raising rates, and that'll put some pressure on gold. It will also put some pressure on stocks once again, right? If we see yields start to head towards 5% again. I know it sounds like it's a long way away, but we saw how quickly we went from 4.5% to 5%, just 2 months ago. It was very quick. And that caused a lot of consternation for the markets, for investors. They were thinking, where could I could take money out of stocks and put it in fixed income at 5% and be very comfortable. And I think that's kind of also one of the fears or one of the concerns. Not so much a fear, but a concern about 2024.
Kenny Polcari from SlateStone. All right, so we are expecting a flat open, just checking ASX futures there, as you can see, down just 1 point. All right, stay with us. The open is next.